For decades, pension systems were built on a simple assumption. Workers would contribute throughout their careers. Retirees would receive benefits later. The system appeared stable because there were always enough workers supporting enough retirees. But demographics change. People live longer. Birth rates decline. The ratio between workers and retirees shifts. At the same time, pension funds increasingly depend on financial markets to generate returns. This creates a difficult challenge. Retirement systems rely on growth, investment performance, and demographic stability simultaneously. If any of those foundations weaken, pressure begins to build. This is the story of pensions, and why one of the most important promises in modern society may be entering a period of growing strain. Pension systems generally operate through two structures. Some rely on current workers funding current retirees through public programs. Others invest contributions into financial markets, building assets intended to support future benefits. Many countries use a combination of both approaches. During the 20th century, these systems functioned effectively because populations were younger and growing. Large workforces supported relatively smaller retired populations. Economic growth provided additional support. Over time, however, demographic trends changed. Birth rates declined. Life expectancy increased. Retirees began collecting benefits for longer periods. At the same time, financial markets became increasingly important to pension funding. Pension funds grew into some of the largest investors in the world. Their ability to meet future obligations became closely tied to asset returns. The system therefore became dependent on both demographics and markets. Pensions promised security. Workers could contribute during their careers and expect financial support during retirement. The arrangement provided stability for households and predictability for societies. Public pension systems promised intergenerational support. Private pension systems promised long-term investment growth. Together, they created confidence that retirement could be financed without requiring individuals to accumulate all necessary resources independently. Financial markets reinforced this belief. Long-term investment returns appeared capable of supporting future obligations. Pension funds diversified globally, allocating capital across stocks, bonds, real estate, and alternative assets. The broader promise was sustainability. As economies expanded, pension systems would expand alongside them. The challenge was that many assumptions underlying this promise were based on historical conditions that might not persist indefinitely. The rise of pension systems coincided with economic expansion during the 20th century. Growing populations, rising productivity, and strong labor participation supported public retirement programs. Financial markets provided additional opportunities. Pension funds accumulated vast pools of capital and became major institutional investors. As assets grew, pension systems increasingly relied on investment performance to meet obligations. Periods of strong market returns reinforced confidence. Low interest rates later encouraged pension funds to seek higher-yielding assets. Private equity, real estate, infrastructure, and alternative investments became more common within portfolios. The rise appeared successful. Millions of retirees received benefits. Large pools of capital supported financial markets. Retirement planning became a central component of modern economic life. But success also created dependence. Future promises increasingly relied on conditions remaining favorable. Pension systems face pressure when demographics and investment assumptions diverge from expectations. Fewer workers supporting more retirees increases costs within public systems. Longer life expectancy increases benefit obligations. At the same time, lower economic growth can reduce tax revenue and contribution growth. Investment-based systems face additional challenges. If market returns fall below expectations, funding gaps emerge. Low interest rates, while beneficial for borrowers, often increase pension liabilities by reducing expected future investment returns. Pension funds may respond by increasing exposure to riskier assets. This strategy can improve returns during strong markets. It can also increase vulnerability during downturns. The challenge is gradual rather than sudden. Funding shortfalls often accumulate over years. Governments may postpone reforms. Institutions may adjust assumptions. Benefits may be modified incrementally. The system therefore experiences pressure long before visible crisis emerges. The vulnerability is not fraud or mismanagement, it is arithmetic. Demographic realities and financial expectations must eventually align. When they do not, strain accumulates. A pension crisis would likely emerge through funding pressure rather than immediate failure. Governments could face difficult decisions regarding taxes, retirement ages, or benefit structures. Pension funds might require additional contributions or reduced obligations. Retirees could receive less support than expected. The adjustment would probably occur gradually. The challenge is not whether pensions disappear, it is how expectations change when promises become more difficult to finance. After periods of pension stress, systems often adapt. Retirement ages increase, contribution rates rise, investment strategies change, benefits may be adjusted. These reforms improve sustainability, but can also alter expectations for future retirees. The system survives, the terms evolve. Pension systems represent one of the largest promises modern societies make to future generations. Their success depends on demographics, economic growth, and financial markets working together over long periods of time. When those forces align, the system appears stable. When they diverge, pressure emerges. The pension challenge is not simply financial, it is structural. It reflects how societies distribute obligations across generations. And like many systems explored in this series, it works best when assumptions remain intact. The question is what happens when they don't?